Okay, well, even as our participants continue to join, I think we should kick off in the interest of time. So, hello and welcome everyone to today's event on how to be an impact leader. We are pleased that so many of you could join us for what will be an interactive conversation on best practices in impact management and how a shared understanding of both the opportunities and challenges in impact management can help us advance the field. We have a fantastic lineup of speakers, all experienced impact investors with us today. Our opening speaker is Maria Koslowski, Senior Vice President, Innovative Finance at the Rockefeller Foundation. And our panelists today include Tomi Amason, Managing Partner at Summit Africa, Elizabeth Boggs-Davidson, Vice President of the Office of Development Policy at the U.S. International Development Finance Corporation, Cecilia Chow, Managing Director at Bain Capital Double Impact, and Jeremy Rogers, Chief Investment Officer at Big Society Capital. Thank you all for being here. Before we get started, just a few quick housekeeping items. Today's event is being recorded and will be made publicly available next week. The first 45 minutes will feature remarks from our esteemed speakers and panelists, and then 15 minutes of audience Q&A. If you have a question that you'd like to submit to the panelists, please use the Q&A function rather than the chat, and we'll try to get to as many of those as possible. So now let's get to the question that brings us all here. How does an impact investor become an impact leader? We have now, thankfully, a lot of good questions to this, a lot of good answers, I should say, to this question, thanks to the introduction in April 2019 of the Operating Principles for Impact Management, or the Impact Principles for short. The launch of the Impact Principles represented truly a game-changing moment in the impact investing industry, in that they outlined in clear, accessible, and actionable terms how an investor should integrate impact considerations throughout the investment life cycle, all the way from strategy design through to exit. Today, approximately 130 impact investors of all types and sizes, including many on the call here, have signed on to the Impact Principles, committing themselves to best practices and, importantly, committing to independent verification of their alignment with the Impact Principles. BlueMark was created in January 2020 as an impact verification specialist to meet the growing market demand for verification services and to help bring more transparency, accountability, and comparability to the impact investment market. So BlueMark now has completed more than 30 impact verifications on investor alignment with the Impact Principles for investors of all asset classes and types. Last week, we published our second, or actually this week, we published our second annual Making the Mark report with aggregated data and insights from these first 30 verifications. The report, which is available on the BlueMark website, also includes 6 case studies featuring BlueMark clients showing how a third-party verification helped them improve their impact management practices. We plan to publish additional research about best practices in impact management as we complete more practice verifications. We also plan to publish research on best practices in impact performance reporting as we complete more performance verifications. So now I'm happy to introduce to you what we call the benchmark for impact investing practice, which we're especially excited about. It's a first of its kind tool that allows impact investors to essentially see where they stand against the rest of the industry and whether they fall into one of 3 categories: practice leaders, which represent the top 25th percentile, and which we would characterize as sort of standard bearers implementing not only all of the core elements of impact practice as embodied in the Impact Principles, They also adopt many leading edge practices that may go above and beyond the impact principles. The practice median represents the 50th percentile, and it reflects the impact management practices of the median investor in our research sample, who implement many of the core elements of impact management practice, but also have significant room for further development and improvement. And then finally, practice learners at the bottom 25th percentile are those investors with, you know, well-articulated impact intentions, but who may be lacking still some of the core impact management practices that are expected of them. Many may be early in their journeys, while others have yet to embed impact considerations at key stages of the investment process. So recognizing that each impact investor is at a different stage in their journey, we see this benchmark as a useful way for investors to see where they stand today and how far they can go. We expect leaders will continue to push the bar as new standards are introduced into the market, and the characteristics of leading practice will evolve with them. So now just a few words on some of our key findings from this year's Making the Mark report. Our analysis revealed some interesting insights about what separates impact leaders from impact learners, areas of advanced practice within the field where there may still be some room for improvement. First of all, not surprising, there's a growing consensus around the use of the Sustainable Development Goals as a framework for articulating impact intentions and objectives. Fully 93% of investors in our sample align their intentions to the Sustainable Development Goals, while still only 48% actually take a step further to align with the 169 targets underlying those SDGs. We're seeing, you know, really, I think, real advancement on impact due diligence in the market, with 93% as well of our investors having a consistent means of evaluating ex ante expected impact with their investees, while still only 17% sort of systematically assess each investment using the impact management project's so-called 5 dimensions of impact. On the challenges side, I think there's growing interest in how investors are aligning incentives with impact. That's still, just as they do financial performance, that's still in its early stage. 43% we find directly incorporate impact into performance evaluations of staff, while only 17% directly tie annual bonuses and just 3% tie carry to impact, also reflecting how complex that practice is to do properly. Impact performance also needs to be more inclusive of stakeholders, broadly speaking. 57% of our sample compare actual with expected impact performance, yet just 11% actually take the step of soliciting input from key stakeholders to understand the effects on stakeholders as a part of a systematic impact performance evaluation process. We also have in our report, I'll just note, a full practice benchmark dashboard, which we believe is a useful diagnostic tool, along with a lot of additional data. So we hope you'll all read the report. We think the varying levels of adoption for certain best practices are highlighted, as are some of the remaining challenges as we collectively seek to scale the impact investing market with integrity. Okay, well, that's for the Making the Mark report. With that, I am very pleased to turn to our first speaker, Maria Koslowski. The Rockefeller Foundation is one of the founding investors in BlueMark, and we are immensely grateful to Maria and her team for their continued support. Thank you, Maria, and over to you.
Well, thank you, Christina, and everyone on the BlueMark team for having me here today. The Rockefeller Foundation is a founding member of BlueMark, and I'll talk about the power of this evaluation tool in a minute, but I did want to touch on just this team. Honestly, when Christina and her team came to the Rockefeller Foundation before they launched, it was the clarity of their vision. I think the commitment to this initiative and the pragmatism that they brought to really get to an evaluation tool that was going to move the needle. And we are here now in a year's time. It's actually incredible to see how much has been done and the number of groups. I think the diversity of managers that you've worked with, because this will really further the asset class. So as I said, I mean, we believed in the power of the tool, but it was the power of the tool that I think a very effective team has now started to put into practice. Its evaluation is just it brings a level of accountability and I think discipline that can really introduce maybe some sophistication at a different level than we have right now in the industry. The approach of BlueMark is really to frame how you look at impact, how groups drive impact, how they report on impact. And that discipline it's just huge as to what discipline can do. I think in the industry itself, I mean, think about it. If you have discipline, if you have a benchmark, everyone wants to meet the benchmark. Fund managers want to meet benchmarks. It fosters, I think, a healthy level of competition, frankly, introduces best practices because somebody wants to get ahead of the next or have a different way to sort of crack the code, if you will. And all of that is going to, in aggregate, I think, deliver actual results, which ultimately is what we need here. And then on the investor side, I think it enables confidence. We try to step back at Rockefeller and not say, like, what impact should each investor try to go after? I think each investor, it's just like doing any investment portfolio. The level of return you're seeking, the risk you want to take, the impact you want to drive, that can be very specific to an individual investor. But then when those investors want to deploy capital in a meaningful way and in meaningful amounts, they want to be able to choose investment managers that state their investment strategies, but actually have delivered on what they're proposing to do. I mean, I think of the BlueMark tool as kind of a bridge analysis to impact. Sometimes in the financial world, we like to do a bridge analysis. You know, how do you get from $1 invested to $2 or $10? And you do all of the steps. And impact's just another KPI. And what I like about the principles is the principles kind of tackle each step in the chain. And so as an investor, I can look at each step in the chain. It's not so much as I think it's difficult to say sometimes which is the best approach, because there's probably going to be different approaches for each different principle that make up your BlueMark benchmark. But it's have investors, have the fund managers told me what they intend to do, and then how do they go after it? And how do I have confidence in that whole process? And I think it makes me as an investor be more confident putting money to work, perhaps more capital to work over time. And I think ultimately is what will make this industry grow. I mean, for all that the impact world has, I mean, it's grown substantially, but it's still in some ways a relatively small piece of the global asset base, if you will. And I think we, you know, certainly at the Rockefeller Foundation, I can tell you right now, though, that is changing. We get calls from big asset managers, small asset managers every week now. It's really picked up as a result of impacts of the pandemic, climate change, racial justice, you name it, there's a big drive to put more dollars to work, and tools that bring more confidence to the asset class, I think will really make a difference. So thank you, Christina and team, for, I think, really making a big mark on the industry.
Well, thank you, Maria. We didn't speak about your remarks beforehand, but that was very generous and also very clarifying, I hope, to the field about where we stand. So with that, I'd like to turn to our panel, and I'd like to start with a question for Elizabeth. Elizabeth, you've been in so many different roles in the impact investing industry, just having moved from UNDP, where you worked on another leading standard, to the U.S. Development Finance Corp. How has the industry's understanding of best practices in impact management evolved in your mind? And then, I'm sure the audience and participants would love to hear how you envision DFC leveraging tools like the practice benchmark and other standards to advance the field.
All righty, well, thank you, Christina. It's a pleasure to be here today. And so yeah, before I get into the DFC, just a little bit of my journey in this impact investment space. So really maybe just starting a short journey. So the last 3 years, I was the director of something called SDG Impact, which is a global UNDP initiative that's really working to drive more private investment and activity to where it's needed to support the delivery of the Sustainable Development Goals. And it was so clear when I joined a few years ago that so much of the activity that is labeled SDG enabling certainly hasn't translated into greater investment activity and capital being directed effectively to the achievement of the goals. And it was so hard to differentiate, and continues to be a little tricky to differentiate, who's using this SDGs as a reporting lens or a tagging exercise, and who's really using those goals to catalyze investment and to contribute ideally to their achievement. So UNDP entered that space of integrity and driving more authenticity in terms of reporting, because there were really no guidelines and no way to measure and to create that needed integrity around claims and investments were in fact advancing the SDGs. And so without clear guidance for what SDG enabling investments looks like, it was just hard for the organizations of the system, particularly UNDP as a steward of the goals, to really authenticate those claims. And so we set out and we had a lot of guidance. BlueMark was sort of getting off the ground at that point too. We were sort of looking at what constitutes best practice. So we set out to develop some practice standards, recognizing that the principles, and particularly the operating principles for impact management of the IFC, which we're launching right at the same time as well, were terrific, but kind of high level guidance for a number of the investment managers and owners and that we were speaking with, that were saying, we really need more granular information on what it means to measure, to manage, to report, to disclose, particularly on the SDGs, but on development outcomes. So we set out to provide some guidance, practice standards, not performance standards, that focus on that internal management and decision-making practice around your strategy, around management, but also around transparency and governance, very much in line with achieving the development outcomes in the SDGs. And so really that experience over 24 months of sort of developing these standards really brought together, I think, the most developed practice in impact management, and really helped us, I think, at UNDP to develop some actionable guidance, which will also include an assurance mechanism that will be helpful for those actors, because our work in the design, there's just such a well-documented need to help a number of industry actors, as you're seeing with your benchmarking, really help differentiate themselves and to bring much more accountability and comparability to the investment and impact market. And so it's been interesting. I joined the US International Development Finance Corporation, DFC, in the middle of March, and I'm the vice president for development policy, so sort of in charge with this mandate now. And the BUILD Act, which launched the organization is a very progressive legislation, which speaks to, it speaks to ensuring appropriate development performance of the agency's portfolio, but it also includes development performance, a really specific development performance measurement system to really evaluate and monitor projects in the portfolio. So the impact, accountability, and transparency were really central tenets of the DFC's founding legislation when it launched in January 2020. And the legislation has positioned the DFC to be a real impact leader and to hopefully manage for impact and results. But the need, I have to tell you, with the new organization is that sort of, it brought to consolidated OPIC and USAID's Development Credit Authority. So while it's a new organization, there's certainly still a need to build that culture around measuring for results. I think how do you install this impact and results focus into the culture of the organization? I think OPIC was very focused on, and for authorization reasons, very focused on their financial returns and safeguarding their environmental and social risk. But there was less of a sort of a focus on managing for impact and results. And so what I'm trying to do with the team and using the tools, and fortunately we are signatories to the IFC's principles, which gives us an opportunity to benchmark ourselves and to understand where we have some gaps and where we need to grow in the space. But so we are, I think, in a position right now after a year of operating where we're much more intentional and strategic in our approach to project selection, and to really thinking about enhancing the development impact ex ante. We've, the US, we've recently launched incredibly ambitious climate targets, and we're now incorporating and developing a new strategy that reflects the new administration's focus, not only on climate, but also on inclusive growth, and that very much, I'm happy to say, aligns with the global sustainability goals. But, and I think all to say that this is very much a work in progress. It is so helpful to have the opportunity to be able to compare ourselves to other like-minded organizations that are trying hard to install not just the tools that allow you to measure and to manage, but the culture that really supports risk, return, and impact, and provides sort of an equal understanding and interest and incentive structure around not just getting your money back and not just safeguarding your risk, but also really being progressive in terms of your development envelope and thinking. So I'm kind of keen to bring a focus on practice and verification to our development impact approach, and to certainly learn and happy to read this new report, just to sort of learn from the practitioners and the different benchmarking opportunities. But there's tremendous interest, and there's a lot of capacity or tools that are now installed, but we need to sort of launch this more specifically as a new agency.
Great.
So I'll stop there and pick up later if necessary.
Thank you, Elizabeth. Appreciate that candor, and so pleased that you're bringing all the deep thinking you've done about what it truly means to be an impact practice, best practice practitioner from DP to DFC. Cecilia, I'd like to turn to you now for perhaps a more commercial take from Bain. The Bain Capital Double Impact team, I think, has been kind of quietly hard at work over a number of years now on the first two impact funds that Bain has launched. And I would love to hear from you how first of all, you and your team gained, what, if anything, you gained from the process of having your impact management practice verified, and how you think about the importance of practice versus as a foundation for impact performance, not to put words in your mouth. What you think about the relationship between IM practice and performance results?
Thank you, Christina. Happy to share some thoughts. And also thank you for including me today, as it's a topic that we're very passionate about. at Bain Capital Double Impact, we really do aspire to be impact leaders and remain best in class in the industry. So we're continuously testing and using various standards and approaches. And so through BlueMark's verification process, we were excited to confirm that across all of our operating principles, our practices, were rated as advanced. And we learned through the BlueMark process that, getting some specific opportunities like how to better document impact underperformance, but we also learned where we're out ahead, like Principle 7 on sustaining impact exit. And so it was really helpful also to understand the broader market landscape, which you obviously, also shared in your report, where the industry practices are strong, like on Principles 1 through 4, but where the market also still has opportunities and practices are less robust at the later stages, like on Principles 5, 7, and 8. And so also on your second question, really the relationship between impact management practices and results. This is an area as an operator I'm very passionate about. I'm cautious as most ESG and impact standards focus on the reporting and measurement aspects. And this is something that Maria mentioned earlier on really ensuring that we achieve our intentions of driving to results. And so I feel, I'm concerned sometimes that there isn't as much focus on the management and outcomes. And so while disclosure and measurement are very important and critical first steps to driving results, I think we all have to remain vigilant that we're not, satisfied with just mere reporting and measurement, that that alone is not a substitute for driving to outcomes. And so what we believe is that through our majority control stake that we take in our investments, that our active ownership approach and partnership with our portfolio companies to deploy impact playbooks really helps to drive to those outcomes. We have a number of cross-portfolio toolkits that we deploy through our Strong Start process, which includes impact, components like the B impact assessment and employee engagement and diversity, equity, and inclusion diagnostics. So we work closely with our companies to identify impact initiatives that are specific to the employees, customers, and communities that our companies serve. And really important also to establish those governance mechanisms that drive that accountability, which includes things like establishing impact goals, establishing initiatives. And we do this also through the budgeting process. So using some of the old tools that we had from the financials, but we embed impact into it. So we embed impact into our budgeting process. We tie management compensation to achieving those specific impact goals. And as we think about really, moving the field, and particularly as you call out in your report, so that the later principles are less robust, we're focused also on sharing some of our learnings and practices with the field. So we plan to publish some case studies on various impact topics in June. Some of the first case studies will include topics like how we partner with B Labs for stakeholder assessments and how we identify improvement opportunities to drive to those important outcomes. By using this approach, we drove almost 30% improvement across our portfolio on our average B impact assessment score this past year. And so it's really important to use these processes that are core in the operational financial world also to impact. We share also in our upcoming case studies on how to more effectively use the SDGs. Christina, as you highlighted earlier, 93% of the firms in your data align with the SDGs, but only 48% are aligned to this 169 targets. I think in a similar KPMG report, they noted that 75% of corporations acknowledge the SDGs in their corporate reporting, but only 1 in 5 have aligned their strategy to SDG targets or indicators. So we'll share some best practices on aligning to those SDGs at the indicator level in our upcoming case study. And lastly, we've implemented processes and tools to better sustain impact exit, another area that has, for the industry, been a little bit less robust. And so we'll use our recent Penn Foster exit as an example to share some of what we've tried to do to help sustain that impact. So overall, I think it's really important to recognize that impact measurement and reporting transparency are critical and necessary steps, but yet must also be coupled with that disciplined action and initiatives to drive to those outcomes.
Thank you, Cecilia. There was a lot in there to talk about. And I just like to share with the broader group of participants, lest people be concerned that the large private equity firms are getting higher ratings in general. We did run some correlations across our portfolio of clients and found there was no correlation between size and ratings. So important point. And Tomi, I'd like to turn to you for a really different perspective here as you're representing a smaller impact manager based and focused on the emerging markets. We'd love to hear how this perspective affects how you think about impact management, some of the sort of challenges and opportunities in terms of your position and the value proposition of going through an impact verification. And before you begin to respond, I'm just going to say to the participants, I see a lot of hand raising and I'm very tempted, but I promise we'll get to questions. We will reserve you know, a good deal of time for Q&A. So please put your questions in the Q&A. Okay, Tomi, over to you.
So Christina, thanks very much. I think the question is very relevant. And the reason I say that is, you know, if you think emerging markets and you think impact investment, I think it stands to reason that, you know, the challenges that impact investment seeks to address are probably a lot more pronounced in an emerging market environment than maybe in the developed markets. And our personal experience, and we focus within our business, you know, our investment focus for impact is on healthcare, education, and financial services. And those are the sort of three key drivers that we use in terms of delivering impact. But what we have found in our personal experience as a smaller manager in an emerging market environment, despite what should be, in our view, the clear benefits of it, is that there's a high level of skepticism and scrutiny around, you know, not just from the providers of capital around the authenticity of the impact objective, but also from, you know, communities where, you know, this is where capital is deployed around, you know, what is really the agenda behind the agenda, if there is any, and how sustainable is that impact that is being promised. So you know, for us, you know, given both the fact that we're a smaller manager and that we're in an emerging market environment, you know, and we truly embrace impact management and the principles, because it does, I think it was Maria that mentioned it in her opening verse, is that, you know, it does create a bridge analysis to impact, and it puts everybody on sort of the same, you know, the same page around, you know, what is going to be done, how it's going to be done, and how it's going to be reported. And so it's a very powerful tool we found in terms of the verification, which is then an independent verification that's done, a very powerful tool to independently and maybe, you know, just measure, verify, benchmark, compare, you know, in terms of not just the outcomes, but also the process, you know, that's being followed, and the genuinity of the process that's being followed in terms of making sure that all stakeholders are adequately aligned. And ultimately, you know, anything that's measured has a much higher chance of being delivered at the end of the day. And anything that's measured independently ensures that, you know, the delivery is actually there, and it's not a, you know, self-proclaimed prophecy, so to speak. So, you know, in the emerging market environment, it certainly builds the trust and creates the platform for trust between all the stakeholders in terms of making sure that impact is actually delivered, but also that the industry in terms of impact grows, which is what's obviously needed, that it grows and that more allocators of capital, you know, see it as a viable option for them.
Fantastic. Thank you, Tomi. Sure they'll be interested in digging in on what it takes to manage all those stakeholders effectively. Jeremy, I'd like to turn to you as the representative Big Society Capital, truly unique organization. In the Making the Mark report, we published a case study on our work with Big Society Capital and how your organization really was hungry and seeking to go kind of beyond the impact principles in many areas. Can you explain sort of what that means to Big Society Capital and why you think it's important, and in what areas to continually kind of raise the bar on best practice?
Absolutely. Thanks, Christina, and thanks for inviting me along. And I guess most importantly, congratulations to the BlueMark team on the report. I think there's really fantastic insight in there for all of us. So I guess in our context, the principles have been really important. As an asset allocator, we used to have our own framework, the BSC impact test that we assess managers by, but actually we spent a lot of time really talking about language rather than approach. And so the principles have been great in codifying, creating a common language around what good looks like in impact management. And increasingly we ask our managers to be implementing them as a result as the time. To your question though, I guess what we try not to lose sight on, as Cecilia and others have touched on, is the goal here is not the principles. It's about building a good understanding of whether positive change is taking place to help drive better investment decisions. And for us, that means really the principles are the start. And like with all investing processes, they should evolve over time as we learn. We try in our work to keep coming back to this concept of impact as a source of value. I suspect, like lots of people on this call, what's interesting to us is where impact understanding can help us see the world a bit differently. And it can help us see where we can build great enterprises that can tackle problems at scale. So maybe let me give a few examples, Christine, that we went through in our work together, specifically around impact culture, actually that Elizabeth touched on, business models, user voice, and then our efforts at systems change. So firstly, on impact culture, that the principles talk a lot to processes and systems, but much less on culture. There's reference to impact performance embedded in incentives, perhaps. But I guess we all know that actually culture is the most important thing in any investment organization. So we'd really try and ensure that purpose and impact is integrated across all our activities. All investment professionals own impact. Everyone on the investment committee owns impact. It's sort of central to learning and the development paths that we build for our teams, I guess. On business models, impact measurement can sometimes be focused on end impact in quite an isolated way with high-level standardized indicators. That's a little bit, I guess, the approach of the principles, actually similar to what Cecilia was talking about. Really our focus is that sort of interplay, if you like, between business models and where impact is possible. And actually that involves a lot of experimenting, iteration to drive value, if you like. So we try and balance standardized indicators with a more open inquiry on where impact is possible. Linked to this is some of the focus we have around user voice. We see this as really important. It's of course also fantastic customer insight to build any business around. So for example, we've worked with 60 decibels that we would really recommend to anyone to do customer surveys of salary finance providers that we've invested in to try and better understand actually where the products are having a positive impact on people's financial well-being, and actually importantly, where they're not. And then finally on systems change, as you touched on, we're a bit of a unique organization. Our overall goal is to build the social investment market in the UK to improve lives. And so we have a whole bunch of broader interventions that go beyond impact on people, I guess. So for example, we target understanding and confidence of social impact investors within particular investor groups that we then track with surveys over time. So that involves, I guess, a slightly different approach from the principles. So I guess in all those areas that we worked on with you, Christina, we've clearly got lots to learn, and actually working with your team was really a big help here. We took the principles as the starting point, and then quite quickly, I guess our discussions got to what else could we be doing in those areas to drive impact as a source of value that was certainly sort of very valuable to us. So hopefully that gives a bit of a snapshot, I guess, of some of the stuff we covered together.
Absolutely, and I think the point, there's so many important points in that. The point about impact culture, I think, really came through in our engagement together, and particularly the real embedded deep commitment to learning that we saw at Big Society Capital, I think is one feature that we're looking for amongst impact leaders. Well, I think there's been a lot of hands raised and Q&A, obviously with almost 200 folks on the call. We won't be able to have everyone ask their questions, but I'd like to tackle one theme that's coming up in the Q&A. Several of the questions have touched on the difference between impact management practice verification and impact sort of performance. So the distinction between having sound practice and really strong performance and results, real results, how they complement each other. I think, Cecilia, you've touched on this. Jeremy, I think all of you have something to say, but perhaps I'll ask Cecilia perhaps to talk first on this question, and then I'll get to another question.
So I think the two are related, but the practice is insufficient. So I think you need to have the practice in order to drive to outcomes, but having the practices alone, I think Jeremy was talking about this, you need to go beyond. It is a necessary and important component, but then you need to sort of work it through with initiatives, operational executions, playbooks to really help drive through to those outcomes. And so what I've learned as an operator is that a lot of what we've learned just in terms of driving financial results, we've had GAP for years, but that just reporting and having strong financial processes does not naturally lead to financial, growth. If it were that easy, I think many companies, would just be up and to the right. But you have to have the practices to establish the diagnostic on where the biggest opportunities are, and then be very intentional about driving initiatives to address those opportunities to improve the results. So practices are a necessary component, but insufficient. And I think, very much leads to what Jeremy was saying, you have to go beyond.
Yeah, I'd add, BlueMark is seeing a lot of market demand for sort of impact performance reporting and results assurance. It's an area of the market that requires more clarity, more consensus around what constitutes quality, reliable, complete reporting, but we're working on that. The next question I'd like the panel to address comes from Tara Mitchell, and she's asking about the relationship between ESG and impact in the asset management market broadly. I wonder, Maria, if you'd like to say a few words about this, feel free to jump in, panelists, as well.
Yeah, look, I think ESG is almost like was a starting point, and it used to just be called environmental, and now we have E, S, and G. And if you really parse it out to environmental, social, and governance, it probably does cover all the categories. I guess when you're thinking about it from a diligence standpoint, generally, ESG, we think more on the compliance side, like is a group following the environmental laws or the, practice standards for employment, good governance, that sort of thing. And I think then when you take on maybe the impact specific, it's almost like going beyond it. So I guess that would be my distinction, but you could argue the definition is all encompassing, yes, but in practice, I think that's how it's done.
I might build on that, if I may, that I think we see it similarly, that ESG is somewhat table stakes. It is historically much more focused on that risk mitigation, that you do your ESG diagnostic and diligence for an investment. Is there environmental hazardous waste? Are there social sort of compliance violations, particularly if you're outside of the United States, but anywhere globally? And so ESG is an important baseline, but impact goes to achieve intentional positive outcomes above and beyond that. And so I think just the market historically, when you use the words ESG, has really focused historically on that risk mitigation side, whereas impact really is getting to driving to positive outcomes.
Great. There's another question. This one comes from Gregoire Stefan, who asks, if we can anticipate regulatory changes related to reporting and disclosure obligations over the next 5 years. That's obviously something we're seeing already, and could that lead to even increased need for, audits and verification of impact? Jeremy, given your position in Europe, I wonder if you want to say a word or two about this, maybe Elizabeth as well.
Yeah, for sure. I mean, I guess every country is different, but certainly in a UK context, we've seen a complete step change in the last few years with our conversations with government about interest in legislating for this. Actually, increasingly it is seen as not a matter of sort of if, but when and in what order. Clearly in Europe, I guess you're starting to see some of that around climate change disclosure more specifically. But it feels from what we see that actually this will really start to accelerate. And I think the big step change, if you like, is that actually, customers have been asking for this. You could argue some employees have been asking for this, but the real change over the last couple of years is in the demand from the investor universe. And actually that has given governments permission in some ways to be the driving force around this. So yeah, I think you will see that. I think that you will see that in some areas at least change quite quickly now.
Elizabeth, anything to add?
Yeah,
there?
no, just to tag on to that, you certainly see this as we're defining climate goals and deliverables and targets. It's very much with that regulation sort of lens guiding us and pulling us to be more ambitious around targets, around climate in particular. So I think that is kind of a welcome opportunity from our vantage point to have regulation really drive more scrutiny and more authenticity around some of our goal setting.
Great. There's another question in the chat, and Tomi, I'd like to turn this one to you if I'm interpreting it properly, but it's really about how to ensure that the voice, I think the voice of stakeholders, whether that be beneficiaries, workers, community members of the community that are affected by a particular investment, are incorporated into the investment process as well as the verification process in an accurate way. How do you, in an emerging markets context, you talked about stakeholders, manage that process of seeking input from stakeholders while making it a practical and cost-effective exercise as an investor who's also seeking a financial return?
Yeah, it's usually, and I think that's a very good question, I must say, and probably the most complicated part about gaining trust, within the ecosystem, in terms of execution. So I mentioned earlier that we focus on healthcare, education, and financial services, and I'll use an example maybe to demonstrate that on the healthcare space. Traditionally, our investments in hospitals, which is the healthcare investments, are in peri-urban or rural or township areas in South Africa, which is basically, kind of previously disadvantaged areas. And what you find is that the community or the other stakeholders have a picture in mind, what they expect you to be doing, and you have a different picture in mind on trying to balance the impact with the financial returns. And what we found really is that the earlier you start the engagement, the better. And as much as possible, we look to bring in what we call shared business ownership with the community, and then bring them along in terms of the decision making, but always trying to balance financial returns and at the same time maximizing impact. So what we found that helps is with the shared business ownership, it becomes more, the decisions that need to be made around impact and the management of impact and the delivery, it becomes owned equally by ourselves as a fund manager by the allocators of capital as well as the various stakeholders, because we're actually all working together for one objective.
Fantastic. Tommy. I think this is a challenge for many investors in the market as far as we've found, but appreciate that view from the ground. There's so many good questions here. I'm sort of struggling. There are lots of questions about how to align financial incentives with impact performance, how such an incentive system can work, and how can investors protect against sort of misaligned incentives in the impact management process that we've often seen, I think, emerge when such incentive structures are very, very narrowly defined on certain KPIs. I'd love to hear perspectives from the panel on this. Cecilia, maybe you want to start again since you've given some thought, and then I see Jeremy's hand.
So I think it's important to tie management incentives. I think what gets measured and compensated against gets done. And so we include impact goals as part of the management incentive bonus. So as part of our budgeting process, we establish the financial targets, but incorporated in that is an allocation of, a percentage of their bonus specifically tied to impact measurements like diversity, equity, and inclusions, for the board and for the management team, like the specific improvement on B impact assessment scores, and like, for example, also bespoke measures that are, specific to the company. I think on ensuring that there's not a conflict, because it's part of our budgeting process for the company, where we talk about, commercial operational impact success, we all as a group align that if we achieve these impact metrics, it will be good for the business. And so we have specifically designed and selected metrics that are intrinsic to ensuring that it is beneficial for the company.
Jeremy, did you have anything to add here?
Yeah, I think that this is a really important subject, and we have a bunch of different experience, I guess, from different funds we've invested in, and the quick answer is it really depends. So let me give you a handful of examples of where it's worked and where it hasn't worked. So we've done this sometimes in early stage venture funds where it really hasn't worked because your impact isn't clear. Actually, for a lot of the investments, the metrics aren't clear, and before you know, you're having unintended consequences of tying in business models, and it works poorly, if you like. On the other side of where it works well, we've done it around social outcomes contracts, pay for success, where actually the metrics are directly linked to financial performance, and it's all very clear at the beginning of it what you're doing. It can work well. And then there's stuff in between, for example, affordable housing projects that we're investing in, where actually, again, the metrics are a bit clearer, if not completely so. So I would approach with caution from what we've seen, but clearly the goal is to do it more where we can.
I'll maybe just add on here, I do think it's a multifaceted topic, and you have to have a balanced approach as to how you're looking at all of the elements. Sometimes the impact and maybe a financial number will be aligned. Sometimes they may not be aligned, but it's like making trade-offs in a company in many aspects, right? Like sometimes you're having to make cost versus quality decisions. And at some level, it's kind of taking that bigger comprehensive view into account. I will say I spent many years in the emerging markets prior to joining the Rockefeller Foundation. I think one aspect that is super important as you think about the impact is also the sustainability issue. Ultimately having investments that are also sustainable so that they can carry on the impact that's intended.
Yeah, the sustainability of impact beyond the life of the investment is I think a theme that more and more investors are aware of now, thanks in part to the impact principles. I'm afraid we're going to be running short on time. So despite how rich this conversation is, and we have got so many questions we haven't gotten to and so many raised hands, I'm going to turn to allow every one of our speakers to just have some parting words So I'd love if, within sort of 30 seconds or less, you could share, just what your bold prediction is for the impact investing industry. What next development should we be looking at on the horizon? So I'll start with you, Tomi, and then sorry to put you on the spot.
No, that's perfectly fine. Thanks very much. The conversation has been really rich. For what we've seen, it's really more transparency, and we think that's what's going to bring just more interest from capital allocators. And I'm speaking as a fund manager. There are tools out there now that we are busy deploying that allow our investors into our funds to see at any point in time live through cloud, through something on the cloud, and they can see what impact is actually happening at any point in time throughout the portfolio companies. And we think that's, that level of transparency, will support the industry.
Great. Cecilia?
I think that, and my aspiration is that impact investing and conscious capitalism will become the norm. I think as we demonstrate along the spectrum of investing, from whether it be public to venture through to large cap investments, that the intentionality and outcomes driven approach, not only driving the financial, that there is no trade-off. I think early on, I know that when I specifically partnered with Deval when we were launching our fund, talked to a lot of folks. The biggest question was, would impact investing be necessarily concessionary? And I think that enough folks have invested. We've had several exits that I think it's becoming proven that it does not need to be concessionary. And so therefore, why wouldn't every form of investment become conscious capital impact oriented?
Great. Jeremy?
I guess building on both of those comments, and also one of the questions is really just to view that impact transparency is coming and that it will arrive quicker than we think. For some of us who've been working in this for a long time, it feels like progress has been slow. But there's just been such a change, I think, in the last year or so in terms of investor appetite. You're seeing it being priced into financial markets. And just one sort of very short story. It was interesting at the beginning hearing Maria talk about the number of investment institutions that are approaching the Rockefeller. We've probably had more private equity firms, investment organizations approach us in the last year than the 7 or 8 years before that. And their question is always the same, which is, we know this is going to be important for our companies. These aren't impact investors, they're just mainstream investors. How do we learn this as quickly as possible? So I think you're going to see a real acceleration, I think, in terms of impact transparency.
Fabulous. I'm feeling the optimism building, Maria.
Before Cecilia said anything, I had in my mind this newer generation or next generation, younger than my generation, is going to drive this to be mainstream. And I really hope that's the case. 20 years ago, I remember being at IFC, and all of a sudden we had to introduce these environmental standards for like every single thing that we did. And I can tell you it was cumbersome at the time, but those small steps, it seemed so slow at the time, but you could just say 20 years later, ESG is now a mainstream thing. I mean, there's always places for improvement, but I think you start with maybe a slower bit of momentum, and as Jeremy said, I think the ball's moving a lot faster now.
Fabulous. Elizabeth, it's all on you now to wrap up.
No, I have to say it's so fun to hear everybody entirely aligned on this answer. That, from my government perspective, I think impact and accountability and transparency that were the founding tenets for this legislation to set up a new development finance organization. I think they will absolutely be realized. I think we are already seeing just a huge interest in shifting, government and strategy and priorities into these development and impact outcomes that are just so important for the world we're living in today. And I think that integrating impact decisions into our traditional ways of working will happen very quickly, because it's very much an interest in a results culture and an interest in being able to measure, manage, and report out on all of the positive and potentially some of the negative work that we're doing. So I feel very strongly that impact investing will grow and expand beyond our wildest dreams. So thank you so much for the opportunity to speak with all of you today too, Christina.
I just want to say that despite that BlueMark's in the position of a verifier, we are learning every day ourselves from our clients, and it's an enormous privilege to be collaborating with leaders like you all on the phone today. I wish we had more time, but thank you all for joining us today on how to be an impact leader.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thank you.
Thank you.